is Sriram from the Commodity Research Desk at Reliance Securities. This is the weekly market updates. So beginning with the bullion side of things, as usual, gold and silver prices in both the international and the domestic markets eased despite sluggish jobs numbers. Markets are still not confident that the sluggish numbers could warrant a cut from the Fed this year. Prices had initially started with small gains earlier after the US Fed remarks were less hawkish than expected. The Fed, in their meeting last week, kept rates steady and were in line with expectations. But Fed Chair Jerome Powell said that it's unlikely the next move will be a rate hike by the central bank. So prices did find some support after the statement, but prices were unable to capitalize from the dovish statement by the Fed governor, and by the end of the week gave up all its gains as investors booked profits after the recent upward rally. The geopolitical tensions in the Middle East eased as well as there were talks about a truce deal between Israel and Hamas, and that also kept the upside limited for the bullion side of things. Looking ahead in the coming week or so, we see traders will remain focused on the prospects for interest rate cuts by the US Federal Reserve going forward. The dollar index gained over the last few sessions has remained upbeat and will cap upside for the markets. Recent Fed talk has also remained on the mixed side of things, with certain members saying that there could be a rate cut by the end of the year, but certain members still feel that inflation remains sticky and only a big fall in the inflation will see a rate cut this year by the Fed. So data has also remained mixed. The Fed talk also has remained mixed. So markets can remain range bound in the coming week as investors try to assess the Fed speak and the data in the coming days or so. On the charts, we feel key range for the international comics futures will be between 2275 to 2375, and in the domestic markets we see the June futures remaining between 70,500 to 71,500. Moving to the energy side of things, starting with crude oil, international and domestic crude oil prices witnessed some recovery last week, upside, but remained capped after EIA data reported a large and unexpected build in the US oil inventories. Of course, the easing tensions in the Middle East also weighed on sentiments and kept the market upside limited. Meanwhile, on the spreads, on the crack spreads side of things, weakness persisted last week as well, with the crack spread tumbling to 1 month low and suggesting weak demand for the product side as well, and also weighed on the crude oil prices last week. Demand too remained weak after weaker than expected economic numbers from the US suggested that the demand can continue to remain weak in the coming few weeks. That also kept upside for the crude oil side. Looking ahead for the coming week or so, we see oil remaining under pressure amid growing hopes that the Iran-Hamas conflict will not escalate further. Additionally, Russia also has said this week that OPEC may be analyzing the possibility of increasing crude oil output before its next meeting in the month of June. So some weakness can persist in the market. Of course, last week we witnessed that Saudi Arabia had increased its official selling price to the Asian region by about 90 cents. But we see markets remaining under pressure as EIA has projected a slight weakness in the demand side of things. And I think we feel that markets could continue to remain under pressure because of weak demand going forward in the next 1 week or so. The key trigger for oil markets will be the inventory data expected out due tonight, and that will be the main trigger for the rest of the week. And on the charts, we feel June NYMEX remaining between $76 to $80 on the upside of things, and domestically we see a range of 6,400 on the lower side to 6,800 on the upside of things in the coming week. Briefly on natural gas prices rose last week on account of lower US production despite ample supplies. Data last week showed EIA inventories increase at a slower pace but still remain near the 5-year average. However, better supply-demand balance and higher feed gas flows to the LNG Freeport supported the markets last week. We feel markets will continue to move higher again, supported by reports of rising LNG feed gas, lower US production, and forecast for slightly warmer weather in the US that could drive up demand for the gas. Inventory data will be the key trigger for the markets this week, and that will be the major trigger for the markets this week, and markets can await data on Thursday. On the charts, we feel the range for the international gas futures on NYMEX will remain between $1.915 to $2.355. And on the domestic side, we feel 160 will be a key support, and a key hurdle for the markets will be 200. And we have to wait and watch if the markets are able to breach 200 going forward in the domestic side. Finally, on the copper side of things, copper eased last week with investors now less hopeful of an interest rate cuts this year. US labor costs continue to grow, raising concerns on inflation and interest rate cuts by the US Federal Reserve and capped upside. Of course, last week when the Fed met, the central bank kept the interest rates unchanged. And noting that only a big fall in inflation will see further cuts in the US going forward this year. However, downside was on in the copper side was capped, and other metals also remained, even though on the negative side of things, recovered from the lows of the week as manufacturing activity in China continued to grow in April. Copper but gave up all its gains by the end of the week amid concerns that the market surge to two-year highs last week was based on speculation, and demand on the physical side from China also remained weak. So we feel markets has started to move in a range-bound fashion. Possibly the key trigger will be the Fed speak this week, and data like jobless claims tonight, and the jobless claims this week, and other data from China, especially the trade balance numbers from Chinese side of things, will be a key trigger for the base metal sector, and markets could remain range bound to slightly with a positive bias in the coming week. Of course, Chinese smelters have definitely cut output, and they also hope to increase their exports, benefiting from the elevated prices, and that could support prices. But demand will be the key trigger at higher prices at these levels. Demand will be the key thing to watch out for, and if there is no demand, we see sluggish markets at least in this week. In the coming week or so, we see sluggish markets. There was a speculation last week that Chinese authorities might be planning some sort of a measures to prop up the economy, but no indication has come from the Chinese authorities. So of course, people are hopeful that Chinese authorities could prop up the economy and some sort of a stimulus can be provided. But till that time, we feel markets remaining range bound. For this week, the key range for COMEX July contract on the future side will be anywhere between $4.55 on the low side to $4.7. And in the domestic side, we see a range between 845 rupees on the lower side to 875 on the higher side of things. So that's it from our side. Thank you very much for watching. Have a pleasant day and a week ahead. Thank you very much.